Here is a number the Federal Reserve published last quarter and nobody talked about for more than a news cycle: $17 trillion. That is what Americans collectively owe in consumer debt right now, today, not counting mortgages. Divide it by the number of households in this country and you get $134,000 per family. Before the mortgage, before the car note on the second vehicle, before the medical bill sitting in collections that you have been ignoring because opening it changes nothing. I have been sitting with a different number for 3 years. 0. That is the total consumer debt carried by every Amish household I have ever been able to document across 44 years of financial records belonging to a man named Ezekiel, a farmer in Lancaster County, Pennsylvania, whose leather-bound ledgers cover 1887 through 1931. No credit line, no installment loan, no mortgage. And in those same 44 years, his family built a farm, raised a large family, survived a barn collapse and a prolonged illness, and passed land to the next generation free and clear, without a single financial product sold by a licensed institution. What Ezekiel belonged to is a system that the modern financial industry has spent 80 years making sure you never clearly understood. Not through any dramatic suppression, through something far more effective, by making debt feel inevitable, normal, and necessary, until the idea of building a financial life without it stopped occurring to most people as a serious option. By the time this video ends, you will know exactly how that system works. Why the 3-phase debt freedom protocol buried in the back of Ezekiel's third ledger has never appeared in any financial literacy curriculum, and what the mathematics of it mean for anyone who is tired of watching their paycheck disappear before it arrives. Stay with me. You already know the number. Not your bank balance, the other number. The one that follows you, the one attached to your name, in a database somewhere that you did not choose to enter and cannot choose to leave. The average American today carries $104,000 in personal debt, not household debt, personal, one person. Credit cards, auto loans, student loans, medical bills, and sitting underneath all of it like a foundation made of wet concrete, the mortgage. A 30-year promise to a financial institution that will collect roughly twice the purchase price of your home before it releases you, if it ever does. $17 trillion. That is what Americans collectively owe right now in consumer debt alone, not counting mortgages. That is not a government statistic designed to feel abstract. That is $17 trillion of future labor already promised to banks, credit card companies and lenders before a single hour of it has been worked. The Federal Reserve publishes this number quarterly. It goes up every quarter. It has gone up every quarter for the last 30 years, with 2 exceptions, both of them recessions so severe that people stopped borrowing, not because they wanted to, but because the system briefly stopped offering. The average household sends $1,500 every month toward debt repayments, not toward building anything, not toward owning anything new, toward the privilege of having borrowed money that has already been spent on things that in many cases no longer exist. I want to show you something that stopped me cold when I first encountered it, because it reframed every financial decision I had made in my adult life. In Ezekiel's ledger, the same set of handwritten records from Lancaster County, Pennsylvania, that I have been studying for the better part of 3 years, there is no debt column either. Not a mortgage line, not an installment payment, not a single entry that reads as money owed to any outside institution. And Ezekiel's family, across those same 44 years, built a farm, raised a large family, survived multiple crises, and passed land to the next generation free and clear. What Ezekiel understood, and what the Amish have preserved through every generation since, is a relationship with money so structurally different from the one most of us were handed that it functions almost like a different language. And by the time this video is over, you will understand exactly why that language was never taught to you, and precisely who benefits from your remaining fluent only in debt. The starting point of everything in Ezekiel's financial world is a principle the Amish call Gelassenheit. It is a German word that resists clean translation, But the financial meaning of it is this: you do not consume what you have not yet produced. You do not borrow against a future that has not arrived. You build from what exists, not from what is promised. To an Amish elder, a 30-year mortgage is not a financial instrument. It is a philosophical surrender, a declaration that you trust a bank's timeline more than your own capacity to build. And the reason that framing matters is not theological, it is behavioral. Every study on household financial resilience, from the University of Michigan's longitudinal consumer surveys to the behavioral finance research at the London School of Economics, shows that households operating under a consumption after production discipline accumulate assets at 2 to 3 times the rate of households operating under a borrow now repay later model, even when their incomes are identical. Gelassenheit is not austerity, it is sequencing. And sequencing, compounded over decades, is the difference between a household that owns things and a household that services debt on things it nominally owns. That sounds austere until you run the mathematics of it. The median American home price today sits around $420,000. A 30-year mortgage on that amount at current rates will cost the borrower approximately $720,000 by the time the final payment clears. The bank collects $300,000 in interest, more than 2/3 of the original purchase price, for the service of lending money it created through a bookkeeping entry. The homeowner works an additional decade of their productive life in net terms to cover that interest load. An entire decade of labour exchanged for the right to have moved in 30 years earlier. Ezekiel's community did not eliminate the need for capital. They restructured where it came from. The Amish land acquisition system operates through what the community calls a Bruderschaft loan, a brotherhood lending circle. When a young Amish family is ready to purchase land or build a home, they do not walk into a bank. They approach the community. A circle of established families, typically 10 to 15 households, each contributes a defined share of the required capital as an interest-free loan. The terms are fixed by community elders, not by a financial institution's risk department. Repayment happens on a schedule the borrowing family can actually sustain, and every dollar repaid returns directly to the contributing households. No interest extracted, no origination fee, no prepayment penalty. The mathematics of this arrangement compared to conventional mortgage lending are almost violent in their clarity. On a $200,000 home purchase, a conventional 30-year mortgage at current rates will extract roughly $170,000 in interest over the life of the loan. The same, purchase through a Bruderschaft circle, costs the borrower zero in interest. The $170,000 to $70,000 difference does not go to a bank. It stays in the household economy, available for the next generation's land purchase, for building reserves, for the kind of compounding accumulation that commercial lending is specifically structured to prevent. This is the mechanism the financial industry does not want discussed plainly, because plain discussion makes the math undeniable. Compound interest is the most powerful force in personal finance. Every banker and financial advisor will tell you this when they are encouraging you to invest. What they do not tell you, with equal enthusiasm, is that compound interest works identically in reverse when you are the borrower. The interest on your mortgage compounds against you with the same mathematical force that investment returns compound for you. The 30-year mortgage is not a financial product designed to help you own a home. It is a financial product designed to ensure that the most valuable asset most Americans will ever hold spends 3 decades generating returns for a lending institution before it generates a single dollar of unencumbered wealth for its nominal owner. Ezekiel's ledger contains an entry from 1904 that I have returned to more times than any other page in those 3 volumes. A neighbouring family completed the final repayment on their Bruderschaft loan for a 40-acre parcel purchased 11 years earlier. The total amount repaid, exactly the amount borrowed, not 1 cent more. The entry is recorded with the same factual neutrality as a crop yield or an equipment purchase. because in that community, paying back exactly what you borrowed was not a remarkable outcome. It was the only acceptable one. Now here is the part of this story that requires the kind of honest arithmetic most financial content refuses to do. The objection you are forming right now is a reasonable one. The Amish system works because it is a closed community with deep social trust and shared values. You cannot simply transplant a Bruderschaft lending circle into a suburb in Ohio and expect it to function. That objection is partially correct. And it is also exactly the framing that makes the underlying principle invisible. The principle is not the Bruderschaft circle specifically. The principle is interest elimination and capital recirculation within a defined community of accountability. That principle has modern, legally accessible expressions that require neither Amish membership nor a religious exemption. Credit unions, specifically the smaller community-chartered variety, operate on a structural model closer to Bruderschaft lending than to commercial banking. Member-owned, with surplus returned to members rather than extracted as profit. And with lending decisions made by people who share geographic and economic stakes with the borrowers. There are currently over 4,500 community credit unions operating in the United States. Most of them dramatically underused by people who default to commercial banks out of habit rather than analysis. And now we arrive at what I found in Ezekiel's third ledger that reframes everything. The layer of the system that does not appear in any modern financial literacy curriculum because its implications are inconvenient for an industry built on the assumption that debt is inevitable. The Amish have constructed what Ezekiel's records describe as a Schuldfreiheit protocol, a debt freedom sequence governing the entire financial life cycle of a household, from the moment a young couple establishes themselves through the moment they transfer assets to the next generation. The sequence has 3 phases, and the discipline of moving through them in order is treated as a community obligation rather than a personal choice. The first phase is the Grundlage, the foundation. No land is purchased, no significant asset acquired until a defined cash reserve has been accumulated. In Ezekiel's records, this threshold appears consistently as the equivalent of 1 full year of household operating expenses, held in physical, accessible form, not invested, not leveraged, sitting, available. The purpose is not return. The purpose is to ensure that no unexpected expense can force the household into debt before the asset base is established. The second phase is the Aufbau, the building. Land or property is acquired through the Bruderschaft system, and repayment of that community loan takes absolute priority over every other discretionary expenditure until complete. Not minimum payments, full accelerated repayment as fast as the household economy can sustain. The mathematical effect is significant. Every month of accelerated repayment returns capital to the community circle faster, making it available for the next family entering the system. The third phase, recorded in those 1919 to 1924 entries I almost missed entirely, is the Weitergabe, the passing forward. Before a household head retires from active management, land is transferred to the next generation through a community witnessed deed with a specific encumbrance. The receiving generation assumes an obligation to participate in the Bruderschaft circle for a minimum of 20 years. They become lenders before they become borrowers again. The capital does not leave the system. It rotates. What this means in practice is that every act of debt repayment within the community simultaneously funds the next family's debt-free entry into land ownership. The system is self-financing across generations in a way that no commercial lending product has ever been designed to replicate, because a self-financing community has no need for a bank, and a community with no need for a bank is a market that does not exist. I am not selling anything, no guide, no program, no course. What I am asking you to do is a single calculation. Take your current total debt balance, all of it, mortgage included, and multiply it by the average effective interest rate you are paying. That annual interest figure is money leaving your household that builds nothing, owns nothing, and produces nothing except the right to continue owing. Ezekiel called that number the cost of trusting a stranger with your future. Leave one number in the comments, your total debt balance right now, as honestly as you can state it. That number tells me where this conversation needs to go next, because the debt system is one half of what Ezekiel's ledgers document. The other half is what his community did with the money they did not send to banks. And that half turns everything I have just shown you from an interesting history into something you can act on before the end of this month.